Right now, the market is fixated on speculative, high-risk bets. But while retail traders chase the next unproven startup, many are overlooking the security of a $100 billion balance sheet. Apple just reported $109.4 billion in quarterly revenue. It's a figure that indicates their core business is actually finding a new gear. This revenue feeds a capital cannon, a systematic deployment of cash aimed at specific growth targets and shareholder returns. Generating this much liquidity provides a unique immunity. Apple has the sheer volume required to absorb market shocks that typically dismantle smaller tech competitors. Consider the scale of this research and development spend. In a single quarter, Apple deployed $11.7 billion. That is a 32% jump over the same period last year. Tim Cook is directing this capital toward a specific endgame. Instead of chasing software hype, Apple is building the proprietary hardware infrastructure needed to weaponize AI across its existing ecosystem. By integrating these advancements into 2 billion active devices, Apple is establishing a permanent digital infrastructure that functions as much more than a collection of consumer gadgets. The 10Q financial statements show total revenue growth of 16%, which converted into $29.7 billion in net income this quarter. The foundation remains the iPhone, where sales reached $54.2 billion, countering the narrative that consumer demand for hardware had peaked. However, the primary profit driver is now the services sector, contributing $30.7 billion to the total. Because the cost to maintain software services is significantly lower than manufacturing hardware, this segment pushes Apple's total gross margin above the 50%. Successfully extracting high-margin software revenue from a mature hardware base transforms the company into a compounding cash machine. This level of cash flow allows for surgical balance sheet management. While zombie companies struggle with rising interest rates, Apple is actively reducing its liabilities. They've slashed their short-term commercial paper, essentially their corporate credit card, from $8 billion down to less than $2 billion. Even with $82 billion in long-term debt, they are holding a $146 billion war chest of cash and marketable securities. Apple uses this surplus to fund a massive share buyback program. By purchasing stock from the open market, they reduce the total number of shares in existence. Over 9 months, Apple has deployed $61.8 billion into these repurchases. Simultaneously reducing debt while shrinking the available share float creates a structural lift for the value of every remaining share. Within the broader tech landscape, Apple's physical and financial footprint remains difficult to replicate. While companies like Google are dependent on the volatility of the advertising market, Apple's revenue is anchored by a diversified moat of hardware and integrated services. This control over the hardware layer provides stability that software-only firms like Meta cannot match. Apple currently possesses the cash reserves of a nation-state, combined with the profit margins typically reserved for boutique luxury brands. The sheer weight of these cash flows and liquidity ratios presents a unique challenge for those looking to bet against the stock. The structural protections built into this balance sheet are difficult to ignore. Investing in Apple increasingly resembles plugging into a self-sustaining financial engine, one that continues to do the heavy lifting for its shareholders.